Question 1. Regulatory requirements for captives in Pennsylvania. Which of the following is not a requirement under the Pennsylvania Captive Insurance Act when applying for a captive insurance license? A. Submission of a feasibility study and business plan. B. Proof of compliance with federal tax laws. C. Minimum capital and surplus requirements. D. Detailed governance structure including board of directors. Answer: B. Proof of compliance with federal tax laws. Explanation. Option A. Correct. A feasibility study and business plan are mandatory to demonstrate the viability of the captive. Option B. Incorrect. While captives must adhere to federal tax laws during operations, this is not a specific licensing requirement under Pennsylvania law. Option C. Correct. Captive insurance companies must meet minimum capital and surplus standards set by the Pennsylvania Insurance Department to ensure financial stability. Option D. Correct. Pennsylvania requires a clearly defined governance structure which includes details on the roles and responsibilities of the board of directors. Regulation references. Pennsylvania Captive Insurance Act specifies the application process, requiring detailed submissions regarding the business's structure and viability, but does not directly mandate proof of tax law compliance as part of licensing. Question 2. Scenario-based. Claims management. Emily Corp owns a single-parent captive domiciled in Pennsylvania. During a recent storm, one of its insured subsidiaries experienced extensive property damage. While reviewing the claim, the captive manager identifies an exclusion in the policy for flood damage, but notices that the claim documentation lacks sufficient evidence to confirm the cause. What should Emily Corp as captive manager do next to handle the situation ethically and in compliance with Pennsylvania regulations? A. Deny the claim immediately due to the exclusion clause. B. Request additional evidence from the insured party to clarify the cause of loss. C. Approve the claim under goodwill to maintain the client relationship. D. Modify the policy terms retroactively to include flood damage coverage. Answer: B. Request additional evidence from the insured party to clarify the cause of loss. Explanation. Option A. Incorrect. Denying the claim without adequate investigation violates ethical principles and fair claims handling practices. Option B. Correct. Pennsylvania regulations require claims to be managed with due diligence and fairness. Requesting more evidence ensures compliance with both legal and ethical standards. Option C. Incorrect. Proving the claim without proper justification could jeopardize the captive's financial stability and violate underwriting principles. Option D. Incorrect. Retroactively modifying policy terms is unethical and could lead to legal penalties. Regulation references. Pennsylvania Insurance Code mandates fair treatment of policyholders and adherence to the terms of coverage. Ethical claims handling includes conducting thorough investigations before making decisions. Question 3. Taxation of captives in Pennsylvania. Which statement regarding premium taxes for captive insurance companies in Pennsylvania is correct? A. Captive insurers are exempt from paying premium taxes if operating exclusively within Pennsylvania. B. Premium taxes are calculated based on gross premiums written minus allowable deductions. C. Captive insurers must pay the same premium tax rates as traditional insurance companies in Pennsylvania. D. Premium taxes are waived for captives providing self-insured retention coverage. Answer: B. Premium taxes are calculated based on gross premiums written minus allowable deductions. Explanation. Option A. Incorrect. Captive insurers operating in Pennsylvania are subject to premium taxes, regardless of exclusivity in operations. Option B. Correct. Pennsylvania calculates premium taxes on the gross premiums written by the captive, with deductions allowed for reinsurance premiums. Option C. Incorrect. Captive insurance premium tax rates in Pennsylvania are typically lower than those for traditional insurers to encourage captive formation. Option D. Incorrect. Self-insured retention coverage does not exempt captives from premium taxes under Pennsylvania law. Regulation references. Pennsylvania Insurance Department guidelines detail the state's tax structure for captives, including rates and deductions applicable to gross premiums. Question 4. Financial management and reporting for captives. Which of the following best describes the solvency requirement for a captive insurer in Pennsylvania? A. Captives must maintain a minimum risk-based capital (RBC) ratio of 200% at all times. B. Captives must ensure that their total assets exceed total liabilities by at least $1 million. C. Captives must comply with statutory accounting principles (SAP) and demonstrate sufficient liquidity to meet claims. D. Captives must maintain a fixed solvency buffer of $5 million, regardless of the level of risk. Answer C. Captives must comply with statutory accounting principles (SAP) and demonstrate sufficient liquidity to meet claims. Explanation. Option A. Incorrect. While RBC requirements are applicable to traditional insurers, captives in Pennsylvania are generally evaluated based on solvency measures tailored to their operations. Option B. Incorrect. Pennsylvania does not specify a blanket surplus requirement of $1 million. Instead, minimum capital and surplus requirements vary based on the type of captive and business plan. Option C. Correct. Pennsylvania mandates compliance with SAP and requires captives to maintain liquidity adequate for timely claims payment. Option D. Incorrect. Fixed solvency buffers are not a standard requirement for Pennsylvania captives. Regulation reference. The Pennsylvania Captive Insurance Act emphasizes solvency requirements aligned with SAP and tailored assessments based on the captive's operations and risk exposure. Question 5. Scenario-based. Underwriting practices. Green Tech Industries owns a captive in Pennsylvania to manage its environmental liability risks. During the underwriting process for a new subsidiary, the captive manager finds that the subsidiary operates in a high-risk area with a history of groundwater contamination. What should the captive manager prioritize in designing coverage for this subsidiary? A. Exclude all contamination-related risks to protect the captive's financial stability. B. Offer comprehensive coverage with no exclusions to build trust with the subsidiary. C. Design coverage with specific exclusions for pre-existing contamination and implement risk mitigation requirements. D. Charge a nominal premium to ensure the subsidiary is insured under the captive. Answer C. Design coverage with specific exclusions for pre-existing contamination and implement risk mitigation requirements. Explanation. Option A. Incorrect. Completely excluding contamination risks undermines the purpose of the captive and may leave the subsidiary without adequate coverage. Option B. Incorrect. Providing comprehensive coverage without exclusions could expose the captive to excessive financial risk. Option C. Correct. Tailored coverage with appropriate exclusions balances financial stability and adequate risk transfer. Implementing risk mitigation requirements aligns with best practices in underwriting. Option D. Incorrect. Charging nominal premiums without proper risk assessment would compromise the captive's solvency and is against regulatory principles. Regulation reference. Best practices in underwriting for captives in Pennsylvania involve customized coverage and risk mitigation measures to ensure solvency and operational efficiency. Question 6. Captive insurance products. What is one advantage of using a captive insurance company for employee health benefits in Pennsylvania? A. Avoidance of all federal insurance regulations under ERISA. B. Greater flexibility in tailoring health coverage to employee needs. C. Elimination of the need for third-party claims administrators. D. Reduction of claims frequency through automatic premium discounts. Answer B. Greater flexibility in tailoring health coverage to employee needs. Explanation. Option A. Incorrect. While captives provide flexibility, federal regulations like ERISA still apply to health benefits, even for captives. Option B. Correct. Captives allow companies to design health benefit plans tailored to employee needs, offering a significant advantage over traditional insurance. Option C. Incorrect. Many captives still employ third-party administrators for claims management to ensure efficiency. Option D. Incorrect. While captives can reduce overall costs, claims frequency is managed through proactive risk mitigation, not automatic discounts. Regulation reference. Captive structures in Pennsylvania provide customization and cost efficiencies for health benefits while adhering to applicable federal and state regulations. Question 7. Regulatory framework for captives in Pennsylvania. Under Pennsylvania regulations, which entity is responsible for overseeing the licensing process for captive insurance companies? A. The Federal Insurance Office, FIO. B. Pennsylvania Department of Revenue. C. Pennsylvania Insurance Department, PID. D. National Association of Insurance Commissioners, NAIC. Answer C. Pennsylvania Insurance Department, PID. Explanation. Option A. Incorrect. The FIO oversees certain federal insurance matters but does not handle state-level captive licensing. Option B. Incorrect. The Department of Revenue deals with tax-related issues, not insurance licensing. Option C. Correct. The PID is the primary authority for licensing, regulation, and oversight of captives in Pennsylvania. Option D. Incorrect. The NAIC provides guidance and model laws, but does not have direct regulatory authority over Pennsylvania captives. Regulation reference. The Pennsylvania Insurance Department administers captive regulations, ensuring compliance with state-specific requirements. Question 8. Risk management and loss prevention. Which of the following strategies is most effective for a captive aiming to reduce claims severity and workers' compensation? A. Implementing a strict zero claims policy. B. Conducting routine safety training and audits for employees. C. Offering higher deductibles to discourage claim submission. D. Limiting coverage for workplace injuries to reduce exposure. Answer: B. Conducting routine safety training and audits for employees. Explanation. Option A. Incorrect. A zero claims policy is impractical and does not address the root causes of workplace injuries. Option B. Correct. Proactive safety training and regular audits significantly reduce the frequency and severity of workplace injuries, aligning with effective loss prevention strategies. Option C. Incorrect. High deductibles may discourage small claims but do not directly reduce claim severity. Option D. Incorrect. Limiting coverage exposes the company to reputational risks and does not mitigate claims. Regulation reference. Pennsylvania encourages captives to adopt robust loss prevention programs to manage risks effectively and ensure sustainability. Question 9. Actuarial considerations in captive insurance. Which actuarial method is most suitable for estimating long-term liabilities in a captive insurer's workers' compensation program? A. Loss development factors (LDF) analysis. B. Cash flow discounting without reserve assumptions. C. Proportional allocation based on premium revenue. D. Reinsurance treaty pricing adjustments. Answer: A. Loss development factors (LDF) analysis. Explanation. Option A. Correct. LDF analysis is a standard actuarial method to estimate long-term liabilities by evaluating historical claims data. Option B. Incorrect. Cash flow discounting requires reserve assumptions and does not provide a complete liability estimate. Option C. Incorrect. Liability estimation should be based on actual claims data, not proportional allocation methods. Option D. Incorrect. Reinsurance treaty pricing adjustments focus on reinsurance costs, not liability estimation. Regulation reference. Captives in Pennsylvania must use sound actuarial techniques, such as LDF analysis, to ensure accurate liability and reserve management. Question 10. Taxation and financial reporting for captives. In Pennsylvania, how are reinsurance premiums paid by a captive treated for tax purposes? A. Fully deductible when calculating premium tax liabilities. B. Subject to federal income tax regardless of deductions. C. Taxed at a reduced rate under Pennsylvania's captive tax code. D. Treated as non-deductible expenses for all captives. Answer: A. Fully deductible when calculating premium tax liabilities. Explanation. Option A. Correct. Reinsurance premiums paid by captives are generally deductible when calculating gross premiums for tax purposes. Option B. Incorrect. Federal taxation applies differently but does not override state deductions for premium tax calculations. Option C. Incorrect. Captives do not have a reduced tax rate specific to reinsurance in Pennsylvania. Deductions apply to gross premium calculations. Option D. Incorrect. Reinsurance premiums are not universally non-deductible. Regulation reference. Pennsylvania's premium tax laws provide clear guidelines on deductions for reinsurance premiums to avoid double taxation. Question 11. Establishment of captives. What is the minimum capital and surplus requirement for a pure captive insurance company in Pennsylvania? A. $100,000. B. $250,000. C. $500,000. D. $1 million. Answer: C. $500,000. Explanation. Option A. Incorrect. $100,000 is insufficient under Pennsylvania's regulations for pure captives. Option B. Incorrect. $250,000 applies to some other forms of captives but not pure captives. Option C. Correct. Pure captive insurance companies in Pennsylvania are required to maintain a minimum capital and surplus of $500,000. Option D. Incorrect. $1 million exceeds the minimum requirement for pure captives but may apply to other types of captives. Regulation reference. Pennsylvania Captive Insurance Act specifies minimum capital and surplus based on the type of captive. Question 12. Captive formation and approval. In Pennsylvania, who must approve the business plan of a newly proposed captive insurance company? A. Pennsylvania Department of Revenue. B. Pennsylvania Insurance Department (PID). C. National Association of Insurance Commissioners, NAI. D. Federal Insurance Office, FIO. Answer B. Pennsylvania Insurance Department, PID. Explanation. Option A, incorrect. The Department of Revenue handles taxation, not business plan approvals. Option B, correct. The PID reviews and approves business plans to ensure compliance with state laws and regulations. Option C, incorrect. The NAIC provides guidelines but does not directly oversee captive operations in Pennsylvania. Option D, incorrect. The FIO does not regulate state-level insurance entities. Regulation reference. The PID is responsible for ensuring that captives meet Pennsylvania's regulatory standards during formation. Question 13. Permitted lines of coverage. Which of the following is a line of insurance typically covered by captives in Pennsylvania? A. Life insurance for employees. B. Unemployment insurance. C. Directors and officers. D. Liability insurance. D. Social Security disability insurance. Answer C. Directors and officers. D. Liability insurance. Explanation. Option A, incorrect. Life insurance is rarely written by captives and typically involves traditional insurers. Option B, incorrect. Unemployment insurance is usually provided through government programs. Option C, correct. D. Liability is a common coverage provided by captives offering protection for corporate leaders. Option D, incorrect. Social Security disability insurance is managed by the federal government. Regulation reference. Pennsylvania allows captives to underwrite a range of commercial and liability risks, including DO coverage. Question 14. Reinsurance requirements. What is one key requirement for a Pennsylvania captive when engaging in a reinsurance contract? A. Reinsurer must be based in Pennsylvania. B. Reinsurer must have an equal rating or higher from an approved rating agency. C. Reinsurance must cover all claims without exceptions. D. Reinsurance premiums must be deposited in a Pennsylvania state fund. Answer B. Reinsurer must have an equal rating or higher from an approved rating agency. Explanation. Option A, incorrect. The reinsurer does not need to be based in Pennsylvania, but must meet financial and regulatory standards. Option B, correct. To ensure financial security, Pennsylvania captives must work with highly rated reinsurers. Option C, incorrect. Reinsurance agreements may include specific exclusions or terms. Option D, incorrect. There is no requirement to deposit premiums in a state fund. Regulation reference. Pennsylvania captive regulations require engaging financially sound reinsurers. Question 15. Captive reporting. Which of the following is a standard annual reporting requirement for captives in Pennsylvania? A. Filing of quarterly unaudited financial statements. B. Submission of an actuarial opinion on reserves. C. Filing of federal tax returns with the PID. D. Biannual review of the captive's business plan. Answer B. Submission of an actuarial opinion on reserves. Explanation. Option A, incorrect. Captives typically file annual, not quarterly, statements unless specifically required. Option B, correct. Actuarial opinions are mandatory to verify reserve adequacy. Option C, incorrect. Federal tax returns are filed with the IRS, not the PID. Option D, incorrect. Business plan reviews are conducted on an as-needed basis, not biannually. Regulation reference. Annual reporting requirements in Pennsylvania include actuarial opinions to ensure solvency and compliance. Question 16. Risk management strategies. Which risk management technique is often used by captives to reduce volatility and claim costs? A. Investing in high-risk securities. B. Bundling unrelated risks into a single policy. C. Purchasing stop-loss reinsurance. D. Eliminating all deductibles for policyholders. Answer C. Purchasing stop-loss reinsurance. Explanation. Option A, incorrect. High-risk investments could destabilize the captive. Option B, incorrect. Bundling unrelated risks may increase complexity and risk. Option C, correct. Stop-loss reinsurance limits the captive's exposure to high-severity claims, reducing volatility. Option D, incorrect. Eliminating deductibles increases the captive's exposure to smaller claims. Regulation reference. Stop-loss reinsurance is the common risk management strategy for captives in Pennsylvania. Question 17. Tax treatment of captives. Under Pennsylvania law, how are premiums written by a captive insurance company taxed? A. Taxed at a flat rate of 2%. B. Exempt from premium taxes but subject to income taxes. C. Subject to a premium tax rate lower than traditional insurers. D. Fully exempt from all state taxes. Answer C. Subject to a premium tax rate lower than traditional insurers. Explanation. Option A. Incorrect. The tax rate varies and is generally lower than 2%. Option B. Incorrect. Captives are subject to premium taxes, not just income taxes. Option C. Correct. Pennsylvania offers captives a reduced premium tax rate to encourage formation within the state. Option D. Incorrect. Captives are not fully exempt from state taxes. Regulation reference. Pennsylvania Captive Insurance Act outlines a preferential tax rate for captives. Question 18. Group captive operations. What is one unique feature of group captives in Pennsylvania compared to pure captives? A. Group captives are exempt from regulatory oversight. B. Group captives require contributions from multiple unrelated entities. C. Group captives can only underwrite life insurance risks. D. Group captives must be licensed in multiple states. Answer B. Group captives require contributions from multiple unrelated entities. Explanation. Option A. Incorrect. Group captives are subject to the same regulatory oversight as other captives. Option B. Correct. Group captives are designed for multiple entities to pool their resources and risks. Option C. Incorrect. Group captives can underwrite various risks, not just life insurance. Option D. Incorrect. Group captives are typically domiciled and licensed in one state. Regulation reference. Group captives in Pennsylvania facilitate risk sharing among multiple members. Question 19. Benefits of captives. What is one financial advantage of forming a captive insurance company in Pennsylvania? A. Complete avoidance of federal taxes. B. Retention of underwriting profits within the parent company. C. Exemption from solvency requirements. D. Access to federal bailout programs. Answer B. Retention of underwriting profits within the parent company. Explanation. Option A. Incorrect. Federal taxes apply to captives just as they do to other entities. Option B. Correct. Captives allow companies to retain profits that would otherwise go to commercial insurers. Option C. Incorrect. Captives must comply with solvency regulations. Option D. Incorrect. Captives do not qualify for federal bailouts. Regulation reference. Captives are an effective financial risk management tool allowing profit retention. Question 20. Emerging risks for captives. Which emerging risk is increasingly being managed through captives in Pennsylvania? A. Flood insurance for private homeowners. B. Cyber liability for businesses. C. Medicare coverage. D. Auto insurance for private vehicles. Answer B. Cyber liability for businesses. Explanation. Option A. Incorrect. Flood insurance is typically covered by federal programs like NFIP. Option B. Correct. Cyber liability is a growing risk that many businesses manage through captives. Option C. Incorrect. Medicare is federally administered and not typically a captive product. Option D. Incorrect. Auto insurance is usually managed through commercial or personal insurance markets. Question 21. Captive formation requirements. What is a key requirement for forming a sponsored captive insurance company in Pennsylvania? A. The sponsor must be a non-profit entity. B. The sponsor must contribute at least $1 million in capital. C. The sponsor must be an approved insurer or reinsurer. D. The sponsor must operate exclusively in Pennsylvania. Correct answer. C. The sponsor must be an approved insurer or reinsurer. Explanation. Option A. Incorrect. Sponsors can be for-profit entities. Option B. Incorrect. Capital contributions may vary but do not require $1 million. Option C. Correct. Sponsors must meet regulatory requirements, typically being insurers or reinsurers. Option D. Incorrect. Sponsors can operate in multiple jurisdictions. Regulation reference. Sponsored captives in Pennsylvania are subject to specific approval and compliance requirements. Question 22. Use of protected cells. How do protected cell companies ECCS function in the Pennsylvania captive insurance market? A. PCCS allow multiple entities to share risk and assets within a single policy. B. PCCS provide legal and financial segregation of risks within separate cells. C. PCCS are exempt from minimum capital requirements. D. PCCS exclusively manage international insurance risks. Answer. BPCCS provide legal and financial segregation of risks within separate cells. Explanation. Option A. Incorrect. While multiple entities co-PCCS, they do not necessarily share policies. Option B. Correct. Protected cells isolate assets and liabilities, protecting individual participants. Option C, incorrect. PCCS must meet capital requirements as specified by the state. Option D, incorrect. PCCS can manage domestic risks as well. Regulation reference. Pennsylvania law recognizes the use of PCCS for segregating risks. Question 23. Captive insurance flexibility. What advantage does a captive insurer offer businesses in Pennsylvania compared to traditional insurance? A. Reduced regulatory oversight. B. Ability to customize policies to unique business risks. C. Complete exemption from state taxes. D. Guaranteed federal reinsurance support. Answer. B. Ability to customize policies to unique business risks. Explanation. Option A, incorrect. Captives are still subject to regulatory oversight. Option B, correct. Captives provide flexibility in designing coverage for specialized risks. Option C, incorrect. Captives are subject to state taxes, though often at reduced rates. Option D, incorrect. Federal reinsurance is not guaranteed for captives. Regulation reference. Captives in Pennsylvania allow businesses to address risks not typically covered by the commercial market. Question 24. Tax incentives. Which tax incentive might encourage businesses to form captives in Pennsylvania? A. Full tax exemption on reinsurance transactions. B. Reduced premium tax rate for policies written by captives. C. Automatic federal tax deductions for losses. D. State-funded grants for captive formation. Answer. B. Reduced premium tax rate for policies written by captives. Explanation. Option A, incorrect. Reinsurance transactions are not fully exempt from taxes. Option B, correct. Pennsylvania offers reduced premium tax rates to attract captive insurers. Option C, incorrect. Federal tax deductions are not automatic and depend on filings. Option D, incorrect. Pennsylvania does not provide grants for captives. Regulation reference. Premium tax reductions in Pennsylvania make captives an attractive option for businesses. Question 25. Governance requirements. What is a governance requirement for captives domiciled in Pennsylvania? A. Appointment of a Pennsylvania resident board member. B. Annual audit by a state-appointed agency. C. Submission of monthly financial reports. D. Prohibition on reinsuring risks. Answer. A. Appointment of a Pennsylvania resident board member. Explanation. Option A, correct. Pennsylvania requires captives to maintain a local presence through governance. Option B, incorrect. Annual audits are required but not conducted by state-appointed agencies. Option C, incorrect. Monthly financial reports are not standard for captives. Option D, incorrect. Reinsurance is permitted and often utilized. Regulation reference. State laws ensure local oversight and accountability for captives. Question 26. Underwriting freedom. What is a primary reason businesses use captives for their insurance needs in Pennsylvania? A. Ability to avoid all underwriting guidelines. B. Freedom to underwrite unusual or hard-to-place risks. C. Requirement to underwrite risks for unrelated entities. D. Elimination of claims review processes. Answer. B. Freedom to underwrite unusual or hard-to-place risks. Explanation. Option A, incorrect. Captives still follow underwriting standards. Option B, correct. Captives excel at covering risks traditional insurers may reject. Option C, incorrect. Captives primarily serve the needs of their owners. Option D, incorrect. Claims review processes are necessary for captive operations. Regulation reference. Captives in Pennsylvania offer tailored coverage solutions. Question 27. Regulatory oversight. Which entity oversees the regulation of captives in Pennsylvania? A. Pennsylvania Insurance Department, PID. B. Pennsylvania Department of Revenue. C. National Association of Insurance Commissioners, NAIC. D. Federal Insurance Office, FIA. Answer. A. Pennsylvania Insurance Department, PID. Explanation. Option A, correct. The PID regulates all captive insurance activities in the state. Option B, incorrect. The Department of Revenue oversees taxation, not regulation. Option C, incorrect. The NAIC provides guidance but does not directly regulate state captives. Option D, incorrect. The FIO does not regulate state-level insurance activities. Regulation reference. The PID is responsible for licensing and oversight of captives in Pennsylvania. Question 20. Solvency standards. How does Pennsylvania ensure the solvency of captives? A. Mandating a fixed surplus amount for all captives. B. Requiring actuarial certification of reserves. C. Prohibiting captives from issuing dividends. D. Imposing federal-level solvency rules. Answer: B. Requiring actuarial certification of reserves. Explanation: Option A. Incorrect. Surplus requirements vary by captive type. Option B. Correct. Actuarial certifications ensure reserves meet obligations. Option C. Incorrect. Dividends are allowed if financial conditions permit. Option D. Incorrect. Solvency standards are state-regulated. Regulation reference. Actuarial certifications are crucial for maintaining solvency in Pennsylvania captives. Question 29. Risk Retention Go RGS. What distinguishes our RGS from traditional captives in Pennsylvania? A. RIS are federally regulated and can operate in multiple states. B. RGS are limited to providing only auto insurance. C. RIS must reinsure all risks with a traditional insurer. D. RGS are restricted to Pennsylvania operations. Answer: A. RIGS are federally regulated and can operate in multiple states. Explanation: Option A. Correct. RIGS are under federal laws, allowing multi-state activity. Option B. Incorrect. RIGS provide liability coverage beyond auto insurance. Option C. Incorrect. RIGS are not required to reinsure all risks. Option D. Incorrect. RIGS are not limited to Pennsylvania. Regulation reference. RIGS follow federal regulations under the Liability Risk Retention Act. Question 30. Fronting arrangements. What is a common purpose of fronting arrangements for captives in Pennsylvania? A. To evade regulatory scrutiny. B. To provide access to admitted insurer licensing. C. To eliminate the need for reinsurance. D. To avoid state premium taxes. Answer: B. To provide access to admitted insurer licensing. Explanation: Option A. Incorrect. Fronting is a legitimate practice under regulatory oversight. Option B. Correct. Fronting enables captives to write policies using an admitted insurer's license. Option C. Incorrect. Reinsurance is often a key component of fronting arrangements. Option D. Incorrect. Fronting does not exempt captives from taxes. Regulation reference. Fronting arrangements help captives meet licensing and regulatory requirements.